The virtual lead marketing conference continues with its focus on loyalty engagement, analytics, and digital applications. I'm your host, John Karolewski. Thank you for joining us or staying with us. We have 2 more presentations today, and I hope you can stay with us the rest of the way. Our next presentation is Creating Collaboration Under the Big Top. Now, this conference is interactive. If you have questions, please type them in the chat box in the lower left of your screen. We'll answer them along the way as time allows. Now, this next presentation and all the presentation will be sent as links to the registered attendees early next week. So joining me now for the next presentation is Joel Cartwright, Solution Consultant with AFS Technologies, a global end-to-end solution provider to the food and beverage and CPG retail industries. So without further ado, here is Joel Cartwright.
Thank you, John. I appreciate it very much. As John said, my name is Joel Cartwright. I'm with AFS Technologies. And just some background on me, I've been in consumer packaged goods for over 20 years. For the last about 7-8 years, been on the software side. In the CPG industry, I've held various finance and accounting roles. I've worked in the world of sales and marketing as well. So in my particular focus is on trade promotion management retail solutions, which AFS Technologies is definitely a big player in that area. So just a little bit about AFS Technologies. We're a global provider with over 1,238 clients worldwide, and we focus primarily in the consumer goods, retail, and supply chain business. So we're specifically in the food and beverage industry. Have over 600 employees across 7 countries, Canada, India, Australia, of course, here in the U.S. as well. With a client base in over 40 countries with our retail execution software, our ERP software, warehouse management software, and of course our trade promotion management, retail and food service solutions. And been in the business for over 25 years, specifically, again, in that consumer packaged goods industry. So that's who AFS Technology is. What I like to do is I like to set the tone for the webinar. Let's just start off right off the bat with a poll question. So real quick on the poll question, what do you believe is the greatest impediment to achieving success related to trade promotion management? And is it people, a commitment, and attention to the details in the TPM tool and plan? Is it internal processes that are getting you bogged down? Technology, capturing data, analyzing data in a more routine business fashion. Establishing KPIs, what's the best way to measure this? Or having willing retail partners to help with you in your process. So go ahead and take a few minutes and let's enter that poll question. Looks like we're getting a strong responses around technology and data capture and analysis. And that seems to be the leader. So we'll set aside all those folks who don't like the whole KPI and financial objective. Maybe at the end of this presentation, you might change your minds on that one a bit. Let's go ahead and let's skip to the results and see what we're seeing here. So as I mentioned, technology and data capture and analysis is the big winner here. And we're slowly coming up, but that seems to be the key on this. I guess everybody works with good, willing retail partners. So let's go ahead and continue on. So in our 3 Ring Circus, there are 3 key players. And this is really a struggle for me when I was creating this presentation, because typically in the circus, you have the Ringmaster, the Lion Tamer, and typically clowns, but I didn't know who to catalog as clowns, so I went with the juggling addict as well. But typically the players in the 3 Ring Circus is the finance organization, who in my experience acts as the ringmaster. They provide the details and the plan details and the targets to align for the organization to build a plan to meet the organization's objectives. There are banks that they have to abide to, dollars, cash, investors, and so forth. And they need to deliver those requirements to the field to drive that plan. The second ring in the 3 Ring Circus is the sales organization, who has a pretty tough job as the Lion Tamer, because they're working with brokers and, more importantly, retailers to crack the whip to make the plan happen. You're managing a broker audience. You're managing the retailers. So you need to make the plan happen. And then the final ring of the circus is the marketing organization, who I've had to deal with a lot of marketing organizations. They have a very, very tough job. They have to provide the balanced consumer strategy, the media strategy, versus the point of sale activity in the store. So it's a nice fine line and a budget they have to work with that has to spread across the entire plan. So let's take a look at each one of them. So what the circuits means kind of during the AOP process. And the AOP process, I like to call it setting up the tent. The circus is about to begin. And as I mentioned, during the beginning comes in the annual planning process. And what the organization needs to do is define the key deliverables, revenue versus volume. Typically, the organizations who I work with and have dealt with in the past with our organizations, they have two key focuses. It's either revenue or volume. There really is not much of a middle of the road. Some focus on net revenue, some on contribution. But typically, those organizations have been able to get over the hump of being able to master their analysis and master their plan. And as I mentioned, it's understanding, do I want to focus on a top-line target or the bottom line? Is it contribution? Is it net revenue? What I want to be? And then finally setting that target. And the biggest hurdle organizations have to overcome is switching from a top-line target revenue plan to a bottom-line target revenue plan. Where they struggle is with the capability of analyzing and having the technology to analyze that data. So what areas will drive the deliverables? Well, I talked about the sales organization is a key driver in delivering the plan. They're going out, they're meeting with the retailers, and they're working with those retailers to align to the retailer plans, but as well to get as much as they can out of the retailer to drive their portion of the operating plan. Marketing has that key deployment. A lot of organizations are having the marketing group or shifting the focus of the marketing group to define what are the specific tactics that the sales organization has to go to when they go to the retailer to get the specific tactics in store. And what I mean by that is the marketing organization is coming to the sales and say, I need you to get 3 feature and displays or 4 feature and displays this year. And finally, there is the supply chain organization. They're going to have to take the sales plan, take the marketing plan, and deliver product that's going to align to that. And the key aspect is to get all 3 of those organizations aligned. Because when the supply chain have vision to what the sales and marketing plans, any incremental activity they're going to be doing, they can deliver all the inventory based upon the orders. So no out of stocks, no shorts, etc. So focusing on the very first one, as I mentioned, the Ringmaster. The center ring is the Ringmaster, is the finance organization. Typically, this is driven in the financial planning and analysis section. Now, a lot of this is combined with the accounting group, but typically setting the finance organization is the financial planning and analysis. They have to meet with a plan that's going to deliver a growth target for their investors, for the banks. The second component is the accounting group. The accounting group with the deduction management piece for that liability, so forth. And then finally, the operations folks have to work with the finance organizations to manage the trade promotion management software, as well as the sales organization support needs. The Lion Tamer role, as I talked about this, the sales organization. This is a key role. Of course, obviously, for most, they have to create the bottom-up plan. And it's the best way that they can align to the company's AOP. They also have to crack the whip to manage the brokers. A lot of the consumer packaged goods companies, the bulk of the companies that I work with, rely heavily on the broker organization. And the biggest struggle that they have is the broker organization has that large binder of very similar products that they're calling on a buyer. The sales organization has to manage that broker to make sure that their products are in the top forefront of that binder. And they can provide that broker organization with the best clear direction on what they need to do to drive their plan. This is typically communicated directly through the account manager of the consumer packaged goods company they're representing. A lot of the communication is done through the trade promotion management software. And what they're doing managing the brokers, they need to manage their contracts and activities. Are the brokers following the plan guidelines? And that means clear communication. I need you to go out and get 3 feature and displays during July. That's our heavy selling season. My price point is 2 for $5 this year. We're going to be more aggressive rather than 2 for $6, or be more aggressive in the second half of the year. A theme focused on manufacturers wanting the brokers to ensure that they're aligning to their net unit cost guidelines. And this is always a struggle, controlling what net unit cost is. And this is best driven, of course, in a trade software. But understanding what the net unit cost and communicating that out to the brokers to make sure they're not overspending to get the volume, they're driving margin as well. Are they getting the defined price point? Is the sales organization defining very clearly, this is my EDLP price. This is what I need you to be at this retailer. My strategy is 2 for $6, not 2 for $5. So understanding what the price points are. And finally, so the brokers to deliver the plan, they need to allow to the account manager's portion of the AOP. Because account managers are calling on direct customers as well. They're calling on the larger customers. So they need to be able to roll that broker plan into their plan to make sure that it aligns to the AOP. In order to do that, they need to confirm that the plans are complete and in motion. Did you have that meeting with the buyer? Are we confirmed with our price points, with our display activity? Making sure that the brokers are validating the brokers are representing the plan that they want to do. They're not straying off the plan. And then back to my question of, are you getting the feature and display activity? Are you getting the price points? Are you getting in the ads? Are you combining with the right entities to make sure that this is happening? So validating the brokers are representing the plan that you've put forward to the senior level of the organization. So they are truly a lion tamer, cracking the whip, managing brokers within this tool. They're also managing the Ringmaster Finance will provide the top-down plan. So let's kind of evolve back to the finance role during the AOP process. What's the finance organization managing? They're managing the financial deliverables to investors, the board, the banks, and the employees. There are different departments in the organization, sales, marketing, and supply chain, that they have to align in order to deliver that top-down plan. Sales, the trade budget, marketing, the marketing budget, supply chain, the supply chain budget, the cost of goods, transportation, etc. And they're also making the final decision on where the investment will be made, trade or marketing. This is a long-term, age-old struggle within organizations, and it's really never clearly defined. Does trade drive the volume? Does marketing drive the volume? It's going to depend who you ask. Sales organization, of course, is going to say trade. Marketing is going to say the media and the consumer information. The finance organization has to have that final say as to where the dollars get allocated. Of course, the sales organization and marketing organization are going to plead their cases on where the dollars need to be spent. Ultimately, their role as the ringmaster in the finance group is to roll out the deliverable to the organization. This is our target, very clearly what that target is. They're going to need to roll up the plan with the different pieces in the organization. So once they have that top-down plan out, they need to be able to gather up the sales plan, the marketing plan, and what supply chain is going to do in the overall AOP. They also need to roll out any wrinkles in the plan, where there are any gaps, identify there are any gaps. Hey, sales organization, we seem to have a big gap in Q4 for this product. How can we make that up? Is it trade? Is it volume? Can I give you more money? If so, what will that drive? From an analytics standpoint, that's where customers really struggle. Where do I deploy my funds? Where do I deploy my money from an analysis standpoint? Volume-driven, contribution-driven, etc. Where I find customers want to evolve to is customer planning by customer P&L, which the finance organization as the ringmaster can support that. utilizing any additional metrics internally that they could roll out to the sales field to help them get there. So they're rolling out the wrinkles in the plan. So finance is going to provide some specific target points. Finance will provide the targets typically in one of the following attributes. The minimal net unit cost. Ultimately, where I've worked, it's always been the best practice to get a cost down to one number, $2.35 a case in net unit cost, 65 cents a unit, to understand what that rate per case or the unit sell price is. So get it down to one number. That gets everybody onto the same page. Now, that may fluctuate, of course, by period within the plan itself, but ultimately, at the end of the day, that's where we want to be, is to get to one number. That number can be a rate per case or as a percentage of list price or a net price to understand, but it ultimately, again, boils down to one number. We want to be 3% of list, 4.5% of list. Some organizations are working towards more of an allocated dollar amount. Here's your budget. This is what I want you to work with. You manage that. Just don't overspend it. A fixed dollar amount. Typically, this is where I see customers when they initially start on a trade software program or expand out their organization or begin seeing growth in their business. They can no longer rely on a fixed dollar amount budget. They need to evolve to a rate per case or some sort of a live accrual. This is a big thing they have to overcome, a big notion or business process they have to overcome. The finance organization, as the Ringmaster, would help me to lead the organization into, all right, we're moving from an allocated dollar amount into a rate per case dollar amount. Finally, determining which will align to strategy, drive bottom line. What do we need to do? We need to focus on contribution or gross margin, however you want to talk to it, or net revenue. What I found with working with many, many different companies that each organization looks at their bottom line differently, a little bit. Contribution, they look at it from a fixed COGS rate or a varied COGS rate based upon the type of products they're selling. Or they focus on a gross margin percentage. I want to be at a specific percentage. I don't want to talk contribution just yet. Or my cost of goods are pretty fixed and I have not a lot of flexibility in my shelf stability, so I'm going to go ahead and focus on just net revenue. But they need the finance organization, though, to determine which will align to the strategy to drive that bottom line. So let's go back to sales a little bit. This is in the second ring. So the sales, a little bit more detail what they're going to be doing during the annual planning process. They're going to be creating that bottom-up plan. So they've been given their top-down plan, their targets, their objectives, where they need to be. Now they have the task of going out and taming the retailer and creating that bottom-up plan. This is where they're planning in an application or an offline in Excel, which, again, back to that technology and understanding the analysis. In speaking with customers who initially go on our software, they're finding that they can't do the type of analytics combining both shipment and consumption data into one resource where they can effectively do annual planning. Where's the best place to deploy my dollars? What's the right combination of tactics do I need to do? Do I need to run a feature and display with an ad? What's the consumption data telling me? What about my price point? Understanding price elasticity so I know what my best price is. Keeping in mind over pricing thresholds and understanding that. But ultimately having all that information in one source and having the flexibility of a tool to present that information in a way that it doesn't require a lot of manipulation in order to put it in a presentable format for analysis. So creating the bottom-up plan by retailer. In addition to that, they have to juggle a lot of customers. In my experience, most of my clients are only able to really plan for that 80-20 rule. Got these 20 customers that plan on 80% of my business. They know that there's growth opportunity in that other percentage of customers, but they unfortunately can't manage it because they're too busy focused on that. By being given the technology and analysis capabilities, they're able to expand that. And I've seen that. after 1 or 2 years of working in the system and able to combine the consumption data and do that type of analysis. They can identify opportunities in the the smaller percentage clients or customers whom they can grow and have huge growth potential with them. They need, again, talking about it, managing the brokers. So going out, meeting with the brokers and making sure they're aligning with the plan and the strategies. And finally, delivering the plan on budget. And here's the question you want to ask yourself. Are my account managers accountable for delivering a plan on budget? There's a lot of companies I've worked with have struggled with this because the sales organization is saying, I need a system or technology to provide me the capability to manage the budget. I need to see that information in real time. I can't rely on an Excel spreadsheet that's delivered to me monthly. I don't have the bandwidth to manage that or have the ability to react. By the time I'm overspent, I'm already committed into a deal, and I'm already planning for it. But delivering a plan on budget, on target. So that's a struggle with an organization initially. Ultimately, though, manufacturers can get to that very easily by able to managing the budget either into that live accrual or the fixed dollar amount. So delivering the plan, and they're delivering the plan on budget. So sales will create, as I mentioned, the bottom-up plan, the best way to align to the company's AOP, and cracking the whip to the retailer plan. They're managing the retailers, as I mentioned before, managing the point-of-sale activities. How many displays can I get? How many can I afford? Should I run the ad in the weekly flyer? Should I run it every 2 weeks? Should it go 10 days? Again, I talked about this before. What's my price point? 2 for $5, 2 for $6? What's the pricing threshold? Price elasticity. A TPM solution or a good trade promotion optimization tool will be able to give you that information by combining the shipment data along with the consumption data, which is a struggle historically. So tell you how many displays can you get? What are those displays driving? The ad and the weekly flyer. Is it a good return on investment? My price point. Can I get away with going for 2 for $6? What's my volume? More importantly, from a contribution standpoint. Not only managing retailers, but managing a distributor, having to deal with the large distribution wholesalers. What's the EDLC price to a wholesaler? Are they deploying those trade dollars to my indirect customers and having the ability to manage that indirect plan within a tool? TPM tools historically very much struggle with this due to the hierarchy structure that indirect retailers have to have within the tool, because traditional TPM tools are only focused on shipments, direct ship customers. So managing that indirect plan has always been a struggle. Providing a solution can manage and be able to manage indirect customers, assign a sales objective, have a spend forecast, and a sales forecast capability within an indirect customer is certainly available, and AFS does offer that. And how much are they selling to those indirect retailers? That's always a very difficult struggle. If I'm managing this distributor and I have a budget I have to manage because of all these little nibblers underneath them, pulling it and biting at my trade budget that I have for this distributor. And again, the retailers delivering the plan which will deliver their portion of the AOP. The final ring of the three-ring circus are the jugglers. Again, this is the one I always struggle with. Do they want to call them jugglers or do they want to call them clowns? Well, we went with jugglers. The jugglers have to manage many aspects to the plan. And this role is typically managed by the marketing group. Marketing typically creates the go-to-market consumer plan that aligns to the company's AOP, while in turn managing the media and the POS retailer with plans. So there's in-store graphics, point-of-sale FSIs. They're managing the media and consumer-focused events, managing the consumer. A good manufacturer should have the ability to align all the radio, television, print sales to the sales plan. So aligning the marketing events to the trade spend events. Typically, customers who come to us initially at AFS struggle with this. They don't have the ability to line that because the sales organization doesn't have vision of that plan. Point two, in order to get to P&L-based planning, being able to encompass that marketing spend and allocate that cost down to an individual retailer. That's always a struggle. But having that capability helps the organization align better to the AOP, keeping the trade spend and marketing budgets flat while being able to grow top-line sales. The traditional grocery detailer Kroger here in Cincinnati, based out of Cincinnati, has a unique and interesting insight, how to increase the consumer basket. And its marketing's department is to increase that consumer basket. I want to get more products. How can I get more of my products into my consumer basket? Is that by the media? Is that by the ads? How can I drive the customer to down the aisle to my products? So I need to increase that consumer basket through the marketing program. Their role as the juggler with the retailers and consumers is they need to deliver a media plan which will deliver their portion of the AOP to the consumer. So you have the sales organization has to deliver a plan, and the marketing organization has to deliver their portion of the AOP plan by the consumer. So you look, the sales organization is delivering a plan by retailer. The marketing group is delivering the AOP by the consumer. Their role, as I mentioned, is defining the frequency of media activity and what combination. So we're seeing more and more of this focus, again, for the marketing group to say, how many different display activities do I have to get? How many how many features do I need to get? How many displays do I need to get? Where do they need to be positioned? What format do they need to be in? Does the retailer have a clean store policy? Can I put a pallet on the floor? What can I get more product in the store that will help move it? And then not only the frequency of the media activity, but how can I focus that media activity? And as I talked about before, if I can have that media activity, can I align it to the sales plan? When I run an ad, would it be great to see my product on sale or at an end cap? So when they see that ad on television or hear it on the radio, they can go in store and quickly identify where it is and have additional volume so you don't have to run the risk of out of stock. So define the frequency of the media activity, the combinations, as well as where to run it. The third ring, as I mentioned, we talked about it. The focus is aligning the consumer strategies, managing the media and the point of sale, or the FSI. So the marketing group, the jugglers, are aligning the best consumer strategies, managing the media and point of sale, but delivering the marketing plan on budget. So let's get more detailed, as we talked about. Marketing is creating the go-to-market consumer plan that aligns to the company's AOP while managing the media and the POS retailer plans. They're managing the media and retail events, managing the point-of-sale activities, aligning FSIs to events to the TPRs. And this is important. It's always good to have, again, your marketing and sales organization aligned. Do I want to run an FSI at the same time I'm running a TPR? How can I analyze that type of event? How do I know what drove the volume? Was it my FSI or was it my TPR itself? So again, a very important notion of understanding how to align the sales and marketing plans. In-store consumer event activity. Do I want to run a sampling? Do I have in-store sampling aligned with the TPR? That type of activity. Again, frequency of display and ad activity. So their role as a juggler for retail and consumers is to deliver a media plan, which will deliver their portion of the AOP by the retailer. Define the frequency of events and what combinations. So the three rings of the circuit, the finance organization who sets down the plan, the targets, the goals, the objectives, the budgets. The sales organization that works in cooperation with the marketing group that has the key role as the Lion Tamer to manage the retailers to deliver a plan, as well as to manage the brokers who can deliver a plan. And then finally, the jugglers who are managing, is the marketing group who's managing the media, the point-of-sale retailer plans, and the consumer activity, aligning them all together in the circus to make sure we deliver a plan. So let's take our final poll question. We just went through what we talked about it. The original poll question said technology and analysis. So what I'd like to know is how are you as the as the attendees on this, addressing TPM collaboration issues. Is your organization working together? So is it an internal or is it a third-party personnel training? Is there a need for a restructuring of the sales team, maybe the sales team's incentives? Improving or purchasing technology. Is it a technology need? Assessing potential customers or retail partners? Or is it really none of the above? Where's the biggest opportunity for addressing CPM collaborative issues? So let's see here. Let's take a few minutes, and we'll get a few folks to respond to that. So it's improving their technology. It seems to be a very hot response this time. So very similar to the beginning. Technology and analysis. The key functioning here. Okay. Let's go ahead and take a look at our results to see. So again, proving or purchasing technology that will provide the ease of use to help bring this collaboration in the three-ring circus under one tent. Okay. So what can I leave you with? What should you do next? After seeing how it works, the best practices that I've worked with, many companies, and kind of pulling this all together, what I would recommend what you should do next is evaluate your organization and find out, is it aligned in a similar fashion? It may not be exactly, but I bet there's probably an aspect that I touched upon that everybody probably needs to take a look at or focus on. Is there one more predominant than another? Is there a better way to communicate between the three rings? Which is the second point. Is there a clear line of communication between the three rings in the organization? Is it too siloed in your organization? Is there a communication or collaboration back and forth? Is it finance just setting forward a plan and not working with any other entities to make sure that the plan is delivered or help to support that? Once you've done this evaluation and seeing if there's a clear line, are there areas that are lacking in the circus? So what are the areas that are lacking in your circuit? Then finally, once you've done this evaluation, I've always been told that in order to make sure to start solutioning a problem, you have to understand that if there is a problem. So what are the areas lacking of the circus? If you've identified that there is a problem, is there an opportunity to make changes and improve the organization? So once you've identified that there is a not alignment in the three-ring circus, we need communication, and they are lacking in certain areas, can we make changes? How impactful would that be to the organization? So for additional resources, eliminating surprise, there is a blog section at AFS Technologies, and fostering collaboration to drive promotion success. There's also complementary industry resources available 24/7 at www.afsi.com. So, John, do we have some questions?
Yes, we do, Joe. We have a couple of questions. The first one, of the three-ring circus rings you described, which is more predominant with these CPG clients you have worked with?
Typically, what's more predominant is the sales organization, but it really depends upon the senior management team makeup. So if I have a CEO who came out of the sales organization, of course, they fall more in line with having the sales role. But typically, a more predominant, I'm seeing the sales organization being the predominant role. Now, as I mentioned during the presentation, I'm starting to see the marketing group aligning more and kind of evening out, I guess you would say, with the sales organization. But ultimately, the finance group doesn't have a key voice or is not heard throughout the process until the end when the decision has to be made. Good question.
Okay, one more, Joel. In your experience, who typically develops the in-store POS tactics, marketing or sales with retailer support?
From what I found, it's typically a combination of both. No, marketing will start with some ideas on what they want to do. Is it in-store graphics, what's been successful, what's other areas in marketing, graphics and so forth, and other areas of marketing being successful. but they bring it to the sales organization who presents it to the retailer. Because the retailer has, specific needs and specific guidelines that they want to follow for their in-store presentations. But what I'm seeing is predominantly marketing brings an initial pass first, and they work in collaboration with the sales and retailers to provide whatever in-store activity is needed.
Okay, excellent. That's all I have right now. If the attendees have any other questions, they can reach out to Joel Cartwright directly by emailing him at joel.cartwright@afsi.com, joel.cartwright@afsi.com. And you had on your screen some information about the website, afsi.com as well. For more information about the Shopper Technology Institute, which produces the Lead Marketing Conference, please visit us at www.shoppertech.org. Thank you, Joel. That was a very, very good, well thought out presentation. I learned a lot and learned a few things I didn't know. Our final presentation of the day is about mobile marketing and CPG companies. It'll begin on the hour at 4 p.m. Eastern. 3 p.m. Eastern, sorry. I hope you can join us. Please stay with us. This is John Karolowski signing off for Joel Cartwright, AFSI Technologies, and the Shopper Technology Institute.